Uh, just a little bit of housekeeping. If you guys have any questions, please feel free to use that Q&A chat box, and we will be getting those questions answered hopefully as they come in and as that information is relevant on that slide. At this point, I'm going to let Miss Mariel from the Farmer Veteran Coalition go ahead and introduce herself, and then we'll go into Mr. Rob introducing himself.
Hi, everybody. My name is Mariel Kesnick, and I'm with the Farmer Veteran Coalition. I am the state coordinator, so many of you will recognize me, and we work together in the state chapters. So I'm happy to be here with Native American and Rob. So.
Yes, thank you so much, Miss Mariel. Okay, now our presenter today is Mr. Rob Holcomb, and please go ahead and introduce yourself, and then feel free to take it away, Rob.
Okay, well, thanks a lot, Harley. My name is Rob Holcomb, and I am an extension educator with the University of Minnesota. I've I've been an enrolled agent for a little over 20 years, and what an enrolled agent is, folks, is I'm enrolled. It's a credential that I acquired from Internal Revenue Service. I'm allowed to represent clients before the IRS. So I had to sit for a 2-day test in order to do that. Plus, I have continuing education requirements that I have to fulfill every year. The As far as the presentation goes, we should be running somewhere in the neighborhood of about a little over an hour and a half, I would guess. Kind of depends on the number of questions that we end up with as we go through the program. But I certainly want to encourage you to go ahead and drop questions into the Q&A or the chat box, and we'll make sure that we address those. So as far as the program goes, I'm obligated to start this thing off today by this work that you're seeing today. It's supported by a USDA grant. All right, we run these grants through the Extension Risk Management Education Program, which is funded through USDA. But the bottom line is this is a grant funded effort that we have here, folks. Whether I'm doing a tax program or whether I'm doing a farm estate transfer program or a business structures program, I typically throw this slide up at the beginning of just about every program. Uh, Whether you're talking about taxes or business entities or farm financial transfer or farm estate transfer, oftentimes we have uh, tax professional or accountant stuff, and then we also have sometimes we encounter stuff that's more legal on the attorney side of things. The one of the scariest calls that I can get in my office is somebody that calls me up, cold calls me and says, "Hey, I bought some over-the-counter tax software. Can you walk me through this step by step on doing my return?" And of course, I can't do that because I'd have thousands of people calling to get that sort of help. But whether you're talking about taxes or any of the topics that we're talking about there, be a good consumer of professional services. A tax professional that's been trained and gets ongoing training is just invaluable for the folks that insist on doing their own return. I've said this for years, decades. I really think they're doing themselves a disservice. I mean, find a competent professional and work with that professional. It will pay dividends in the long run. Now, the next thing that we want to look at here is, to want to kind of acknowledge where we've got some of our material coming from. A sizable portion of the material that I'm going to cover with you today comes from textbooks that are put out by the Land Grant University Tax Education Foundation, or the acronym for that is LGUTF. But LGUTF puts out several different textbooks that we use for our respective tax courses at our universities, and the other role that I have is I happen to be the tax school director at the University of Minnesota. So we do utilize those textbooks for our tax courses. One of the other roles that I participate in is I'm on the Publication 225 committee, which one of the things that the Publication 225 committee does is we populate fact sheets with ruraltax.org. And you can utilize either that website or that QR code from the slide in order to access that website. Lots and lots of fact sheets, a lot of good information, and I'd encourage you maybe to check out that website. That information is all free, all completely 100% free. And also I will be taking a fair amount of material today from directly from the IRS website, just to document that. Internal Revenue does have a fairly easy to manipulate uh, website, and they do have a lot of valuable information with that. Now, our agenda today, and the time that I have you, it's an ambitious agenda for our time that we have here. I want to start off talking a little bit about record systems. We want to talk a little bit about character of income, and we want to also hit tax planning strategies. All right, so because most farmers are calendar year filers. Most farmers are also cash basis filers. We'll address both of those as we go through the program. But what that means is that before the end of the year, we've got till, if you're a calendar year operator, you've got till December 31st to get all of your transactions buttoned up for the year. And there are certain things that you can do up till the 31st of December. Let me clarify. There are certain things that you have to do before the end of the year you can't do after the beginning of next year, and there's some things that we can do to the return after the first of the year. So we want to differentiate those a little bit. I do have a couple of one particular I want to walk you through a tax planning example and show you how the income tax system works with the rates and everything, and how prepays and some of the tax planning strategies are affected by that. And we want to wrap that up by taking you through a quick tour of Schedule F, which for most folks who are sole proprietors, that's going to be the tax form that you're going to see filled out with your tax return. So, whoops, one too many clicks. Okay, few words on records. Let's just kind of lead this thing off with some records pieces here. Now, uh, folks, let me just share. I started out as a high school ag teacher right out of college, and I taught high school ag for 6 years, and then I've been doing the tax and analysis work ever since then. Well, basically I switched to doing that work in 1990. So you do a little bit of math, you can kind of figure out how old I am. But in that whole amount of time that I've been working in this tax and analysis realm, farmers are not, their favorite thing to do is outside doing farming stuff. I mean, if you're a livestock producer, they want to be out in the barn, or they want to be working the livestock. If you're a crop producer, well, they want to be doing something with the crops, driving a tractor, scouting crops, doing whatever that they love to do. The last thing on the planet that most farmers want to do is sit down and go through and put together a set of accounting records. All right. It's just not their favorite thing to do. And it's nothing to be ashamed about. But because if you don't recognize it, it's hard to deal with that thing. But it's one of the most necessary things that's out there that we have to do. Folks, before you can effectively tax plan, you have to know where you're at. All right. That is just a critical thing. Now, that's probably a poor thing for me to be saying on the 17th of December, which is the day that we're presenting this. Now, if you don't have records put together yet for 2024, that's going to be quite a chore to try and get that done. and try to get an appointment with the tax accountant before the end of the year for fall tax planning. But you have to know where you're at. You have to know how much income that you have, how much expense that you have in order to make any of those year-end decisions. Now, software or manual record books, they work fine. All right, folks, when I first came to the university, I was a field staff person for one of our farm management associations. So I had about 100 farmers that I was working with, helping them with records, doing farm consultation. I would do the tax return and their farm analysis. And some of the most profitable farmers that we had in the association at that point in time were still keeping a manual record book. All right. So there's no stigma about doing a manual record book. It's labor intensive. You got to add the thing up with an adding machine or a calculator. It's a lot more work, I think, than doing computer software, but either one will work. All right. Computer software, I think, is probably the way to go because most folks have access to a computer nowadays. The main thing is to make sure that you have a system. All right, it's important to have a system in place, even if it's just dropping stuff into a spreadsheet and adding up the columns. And there's free templates out there online all over the place that you can download that will take care of that. The the reconcile. Now, what I'm talking about there is I'm recommending that when you implement a record system, make sure that you take time to reconcile those monthly records back to your bank statement. All right. What that ensures you of is that make sure that you've accounted for every penny in your records that pass through your checking account. All right. In an IRS audit, that can shorten it significantly. All right. If you can show that auditor that, all right, we've accounted for everything that passed through the checkbook, and we may have some debate on how some things are coded, but we've accounted for all the cash. All right. That resolves huge mistakes that I've seen over my 30 plus year career. All right. It once I've had anybody that started reconciling, they never went back. All right. It's a habit that you get into, and it's something that you really want to pay attention to. Now, any record system that we're going to talk about here should be able to separate farm income and expense. There should be a section for capital purchases, which is, I may probably have a lot of folks out there that are livestock producers. If you purchase breeding stock, that's a capital asset. We have to depreciate that, right? If you buy a tractor, we have to depreciate that. If you build a barn or a machine shed, we have to depreciate that. Certain things we can't just expense, so it goes in a different spot in the records. I also like to keep track of the loans in the record system as well. And I'm also a very big proponent of keeping track of the family living. All right. We have a saying in the Farm Management Association: if it's not written down, it didn't exist. And there's a lot of truth to that. Unless you track all that family living, you're not sure how much it's costing you to live. So plus the other thing that we need to also be conscious of with this is when you keep your record system, we also need to realize that we need to be able to separate farm expense from personal expense. All right. For instance, in most cases, a farmer can't deduct the utility bill on their personal residence. All right. Now, if they have a office in the home, perhaps a small portion of that, but as a general rule of thumb, the utility bill for the personal residence is a personal expense, as opposed to if you've got the utility bill going to the hog barn. Well, that's a completely different deal. That's 100% business expense. So it's real important to be able to differentiate what's farm expense and what's not farm expense, what's personal. All right. Now, we're going to shift gears. We're going to go in and do a tax refresher, folks. I've got to go through and we're going to define what some of these mystical terms are in the income tax world. All right, ordinary farm income. All right. Now, what ordinary farm income is in your farming operation when you sell commodities. All right. If you sell corn, soybeans, wheat. I know I've got native producers out here. I've done some work on in the Navajo Nation. All right, if I'm sitting in Tuba City, Arizona, and I'm selling blue corn, all right, that's a commodity sale. All right. Uh, if I'm selling lambs, if I'm selling calves, if I'm selling any type of raised commodity, that's going to be farm income. It's going to go on my Schedule F. All right. So that's why in the record system it's important to understand where this stuff goes. Okay, this is farm income that goes on Schedule F. All right. Now, capital assets. Now, if you go to a textbook, folks, and you look up the definition of capital asset, this isn't going to be it. All right. It's just not. This is Rob's layman's terms definition of this. Now, the what I refer to capital assets is anything that we buy that we have to depreciate. All right, examples of that would be machinery. If we buy breeding livestock, if we put up a building, that's stuff that we can't just write off on Schedule F. We have to spread that cost out over time. All right. Now, the capital assets. When we look at these capital assets, they're taxed in a different way if we sell them. All right, when we buy them, we have to depreciate them or spread out that expense. But when we sell them, it gets different tax treatment from what our ordinary farm income does. That's why we have to separate it in the records. All right, critical that happens. So sale of capital assets, most cases, sale of capital assets is going to be depreciation recapture or capital gain. It's going to be one of the two. All right. Now both both of those have their own tax rates, and actually either one of them gets preferential tax treatment compared to ordinary farm income. So it's to our advantage to be able to identify those capital assets because we get preferential treatment on those on the tax return. All right. Now, many of you that are participating today might have off-farm income. All right, and when you have off-farm income, you're very likely getting a W-2 at the end of the year. Well, when I say the end of the year, it'll be showing up probably the third or fourth week of January. But that's going to report your wage income. All right, that wage income then gets reported on the tax return. There's no business aspects to that or anything like that, but whatever the amount of money that you earn in wages, it just gets taxed at whatever rate that we happen to be in at the time. And I've got charts showing you tax rates here later on in the program. Now, the other thing that we want to talk about here is there's two different types of tax that we want to recognize. There's regular tax, and then there's self-employment tax. Now, a farm business is considered business income, and when you report business income on a tax return, it's going to be subject to self-employment tax. All right. Business income is going to be subject to self-employment tax. So a farming business is certainly going to be subject to that. Uh, there's a lot of words on here, but essentially, self-employment tax runs 15.3%, and there's some deductions and adjustments that get made. But if we just think of this as 15.3%, I think that's probably, from a simplistic standpoint, that's essentially what we're talking about here. Now, there's two components to self-employment tax. All right, the OASDI stands for Old Age Survivor and Disability Insurance. That's of the 15.3%, OASDI is 12.5%. All right. Now, there's also a 2.8 Medicare portion that's part of that. Add those two up and it comes to 15.3. The 12.5% gets capped at 168,000. So if you've got more than $168,000 worth of income on the return, that OASDI gets capped. All right, but the 2.8% goes on into infinity. All right, and that's going to be important when we look at a chart here a little bit later. Uh, in case you have any kind of a rental or investment income. All right, the other term that we sometimes use for this is passive income. It's income that's an investment, but it's not a business. All right, farm we're going to pay self-employment tax on. Investment income we typically don't, because it's not considered a trade or business. So it gets taxed whatever the regular rate is, but we don't have to pay self-employment tax on that. All right, depreciation. Now we touched on this a little bit earlier. Now, when you buy machinery, if you buy breeding livestock, say for instance, if you're a cow calf operation and you happen to buy a cow, or you bought a heifer, or you bought a bull, you're going to have to depreciate her. You're going to have to spread that out over time. You can't just take it as an expense at the time. Now, I'm going to be very careful in how to explain this, because one of the things that makes income tax so complicated is there's a million exceptions for everything, and this is one of those exceptions that falls under the depreciation rules. About 10 years ago, IRS did come out with some clarity. They added clarity, which I look upon this as a good thing. They came out with what we commonly call the repair regulations. All right, the technical term is the tangible property regulations, but essentially what happens with that is with the repair regulations, if I have an expense that I've got an invoice in hand and it's under $1,500, I can go ahead and just count that as a repair, and I don't have to depreciate it. So case in point, if you bought a bull for $1,000, you can just no, that's a poor example. Scratch that. If I let's say for instance that I took my tractor to the repair shop in town, and I have the bill came back and it was $1,400. All right, under $1,500, which is the threshold, I don't have to depreciate that. I can just put that down as a repair because it's under the $1,500. The two thresholds for this, the threshold for most preparers, for most taxpayers, is going to be $1,500. All right, if it's under $1,500 for an invoice for a repair item, we could go ahead and just take that as a repair item. There's also some thresholds or some safe harbors that are out there for maintenance. There's also one for building repairs, and you're probably going to want to seek some advice of your tax professional in that regard when you're looking at that. Now, when you sell a capital asset that you've depreciated, right? It's going to be taxed as depreciation recapture. All right, and we're going to give you some examples of this. Now, the now, well, when we're trading machinery, this is going to happen. We're going to have a deemed sale and some depreciation recapture. The nice part about depreciation recapture is it's ordinary income, but we don't have to pay self-employment tax on it. It gets reported on a 4797. We don't want to put this on Schedule F, because anything you put on Schedule F you're going to be paying self-employment tax on it. All right. Again, this is where the records component is so terribly important, to make sure that your tax professional gets this stuff written down right. Okay, so let's just look at this example. Let's say we got a producer here that sold a tractor for $20,000. All right. Now, what we're assuming is that they bought this tractor and they did a fast write-off on it several years ago. So what we've got is we got zero basis in it. We got no basis left in it at all. So the full $20,000 is going to be taxed as depreciation recapture. All right. So we're going to pay ordinary income on that, no self-employment tax. All right. Now, back in 2017, the Tax Cuts and Jobs Act changed how we handle machinery trades. The technical term for this is like-kind exchange. All right. Under the and the TCJA stands for Tax Cuts and Jobs Act. It changed the like-kind exchange rules so that the like-kind exchange only works for real property. Real property is going to be land and buildings. All right. Does not include machinery. All right. So when we do machinery trades now, we're going to have to handle a little differently. Now, this is the old method. This is how machinery trades used to be handled. All right. Pre 2007, pre 2018. If I went to the implement dealer and I was trading an old tractor in, all right, let's say the implement dealer allowed me a $20,000 allowance on that traded tractor. All right, the new tractor that I was going to buy is $45,000. Well, what we do is we take the new tractor price. I get a $20,000 allowance. I pay the implement dealer $25,000, and I walk away with a different tractor. All right. In the old method, I didn't have to recognize that as income, that trade-in item. I didn't have to recognize that. Under the new method, all right, the new method, this is 2018 moving forward, I have to treat that $20,000 allowance as a sale. All right, so I'm going to show that as a sale amount, and what I show on the depreciation schedule is my full $45,000, right, that I have there. Okay, I'm going to take a moment here to just sort of look at the Q&A here and try to address. Yes, I will be. Okay, the question is, am I going to be discussing 179? Absolutely, I will be. Uh, and okay, most everything that we're going to be talking about here is sole proprietor. The tax components for the LLC. What I would recommend you to do is tune in on Thursday's webinar. I'm going to be talking more about the operational aspects of LLCs and corporations on the webinar on Thursday. All right, but no, we're not going to get into LLCs today. Advice on finding a farm tax attorney. I think one thing to start off with in answering that is if you go to the IRS website, there is a P10 listing. P10 stands for practitioner ID number. Practitioner tax ID number is what P10 stands for. There's a public listing on the IRS website of everybody that has a P10. Anybody that does a tax return for a fee has to have a P10. All right, I have a P10. Anybody that does tax returns for that. Harley, I'm going to let you handle the registration link for Thursday's webinar on that. Coming back to that, P10 listing would be one way, and that's a listing of everybody. You can download that as an Excel spreadsheet. Now, I think from a practical standpoint, you talk to your neighbors, you talk to people that you do business with in the community. It's not often that you just have somebody that just does nothing but farm returns in their practice, and that's all that they do. Oftentimes you got, I guess when I was with the Farm Management Association, I did a fair amount of non-farm returns. All right. So, maybe talk to your neighbors, talk to your friends, maybe talk to some of the businesses. If you've got a local co-op, maybe talk to the folks of the co-op, find out who's doing returns for other farmers in the, that are members of the co-op. I mean, it's a lot of it is just networking is what you need to do. Okay, coming back to this capital gains. Now, we talked about depreciation recapture and capital gains. There's the thing worth noting on capital gains is capital gains have their own tax rates. All right, and I took this right from the IRS website. These are the breakpoints for different capital gains rates. Now, folks, my guess is of the folks that are on this call today. All right, actually, generally speaking, for farmers, the two things that are most likely to get capital gains treatment on the sale of an asset is one, if you're selling land. That's going to typically get capital gains treatment as long as you bet the holding period of 1 year or more. The other thing that most commonly I stick on a return as capital gain income is if I've got a cow calf producer and you sell a raised cow. Right? If you sell a raised cow and we held on to her for more than that 2 year holding period, we get capital gains treatment on that. And the capital gains rates are very favorable. They're much more favorable than sticking it on Schedule F. Again, that's the key reason why we need to do a good job of keeping the record straight. All right. Now, let's come back to this depreciation recapture piece and how this interplays with the depreciation recapture, how it interplays with capital gains. This is a chart that I've used for years. Let me get my laser pointer going here. Now, what we're going to start off with is we bought, let's say, a piece of machinery for $10,000. All right. And over the period of time that we held this piece of equipment, we're going to depreciate that asset $5,000. All right. So 10,000, we depreciated 5. That means we've got adjusted basis of 5,000. All right, which is kind of a deduction that we can take when we sell it. All right. Now here's something that's never going to happen in a million years. Okay, we're going to sell that asset for $20,000. All right, which, you know, in today's crazy economics, you might actually see something like this. Normally, you don't sell used machinery for less than what you bought it for, but it can happen. All right, so we've got a $20,000 sale price. We take the $5,000 as a deduction right away. All right, that's a deduction. Nothing happens with that. To go from here to here, we've got $5,000 of depreciation recapture. All right, that's ordinary income, no self-employment tax. We don't get capital gain treatment on this machinery sale until we sell it for more than what we originally bought it for. All right, so if this actually happened, $20,000 sale, we'd end up with 5,000 of depreciation recapture. We'd end up with 10,000 of capital gain income. All right, but the only way you get capital gain on depreciable assets is if you sell it for more than what you paid for it. All right, that's the only way. Okay, now let's talk a little bit about QBI. Okay, QBI is a deduction that you're going to see on the front of the 1040. It's qualified business income. It came out of the Tax Cuts and Jobs Act from 2017. And largely the reason why it did was one of the things that the Tax Cuts and Jobs Act did is it set a permanent flat rate for corporations. So a C corporation gets a flat 21% rate. All right, all income for a C corporation is taxed at 21%. There's no graduated rates or anything. Well, since corporations got that, Congress kind of felt like, well, we got to do something for everybody else, and that's where QBI came from. All right, so what QBI is QBI is a 20% deduction off of the total business income that you've got on your return. All right, so if you've got, just to keep the numbers easy, if you've got $100,000 worth of income on your Schedule F, all right, 20% of that's going to be $20,000. Now there's some other adjustments that have to come off here, but just want to give you the basic. That's essentially where that QBI deduction is coming from. It's essentially 20% of the total business income. Now, the other place that you can get QBI from is if you're doing business with a co-op. All right, if you're doing business with a cooperative, the cooperative has the opportunity and the ability to pass through a QBI deduction on the 1099 that you get from the co-op. Okay, the 1099 that you get from the co-op is a 1099 PATR, or we call it the 1099 PATRA. Now, that pass-through QBI that comes through on the 1099, that just gets reported on the tax return, and you get that deduction that carries through to the front of the 1040. All right, there's nothing bad about it. Everything about this is good. All right, now the one thing that I do want to point out, and this is something that you folks are probably not going to be involved with necessarily, But if you are doing business with a cooperative and you're doing your QBI deduction on your return, if you're doing business with a cooperative, there is a mandatory reduction, because if I back up the slide here, you'll notice we get two QBI from two different locations. Get 20% of your business income, and then we can also get the pass through coming from the co-op. So in other words, we're kind of double dipping on this thing. So what the point of the reduction is if we're doing business with the co-op, we have a mandatory reduction. Otherwise, because basically we're double dipping on the qualified business income deduction. All right, so, and that's something that your tax preparer is gonna handle for you. Now, this is a chart that I've been using for decades, literally. When we start talking about the tax planning aspects of things, we look at this chart here. Now, this chart is really basic simple. All right, this chart assumes that all income on here is subject to self-employment tax. It's all business income. All right. Now we're not including any kind of state income tax on this whatsoever. But folks, let me just walk you through what's happening with the chart here. Okay, the blue line is the regular tax rate. All right, and this is for married filing joint status. All right, if we were to pull up the different filing statuses, this chart would look similar, but the dollars would change on the bottom axis. So with a married filing joint, we've got a little bit of a 10% bracket. Get my laser pointer going here again. We've got a little bit of a 10% bracket here. Then we jump to a 12% bracket, and that 12% bracket runs to about 94,000, and then it jumps to 22%. All right, and it runs out. Now rates go all the way up to 37%. If we were to run this thing off to the right, it would run on for several feet. I wanted to keep the chart under a reasonable amount on this. Now, the orange dotted line here, that's the 15.3% self-employment tax. All right, that runs out here to $168,000, which is the maximum for that old age survivor disability insurance, and then it drops down to that 2.8%, and that goes out into infinity. All right, so the green line, all that green line is doing is just combining the two. All right, so what this green line is showing you is that's essentially your marginal tax rate on income at those various levels. Now, this does not take into account the qualified business income deduction. So that when we do our tax plan, that's gonna kind of goof the percentages up a little bit on this. But for all practical purposes, when I sit down and do tax planning with somebody, what they do, typically we do that tax planning in November and December. All right, they walk in the door, they've got their records. All right, we look to see, all right, here's what they got on the books so far for income and expense, and we calculate a net. And if they're sitting up here in the middle of the big green hump, and from a federal standpoint, that's about a 37.5% tax rate. If you live in a state where there's a state income tax on top of that, just tack that on top of there. That's a spot that you don't want to be. So oftentimes, either through fast depreciation or prepayments or just spending additional farm expense, when we try to get people to move from here down to maybe here. All right, because to move from here to here, we're getting a pretty big bang for our buck because we got this really high tax rate here. So every dollar that you spend, you're getting a pretty good return on reduction of taxes paid. So I tend to spend a lot more time on rates than I do dollars. All right. Now that's not to say that if somebody walked in the door and they were sitting like here and they wanted to buy themselves down to here, well, that's perfectly possible. But folks, you see that we're in a lower tax rate in right there. So if we spend an equal amount of money, we're not going to get quite the tax savings because the rate's lower here. All right, we're going to reduce the total tax bill, but you're not getting quite the big bang for your buck when you increase expenses or take fast depreciation. Okay. So on the strategies, all right, the things that we're going to talk about here a little bit in our time that we have here today is I want to talk a little bit about prepaid expenses. All right, and that's I think one of the best things that producers can do. I want to share everybody how income averaging works. We want to talk a little bit about deferral of income, accelerated depreciation. We already had somebody that was asking about 179 in bonus. We'll talk about that, as well as crop insurance deferral. All right, so we've got a number of things to talk about here in this particular section. So when we're talking about prepaying expenses, all right, the typically the rule, there's several rules surrounding this, but the main rule that we have to be concerned with is when you prepay a farm expense, you've got a 12-month rule that we have to play with. All right, the benefit of the expense can't exceed beyond 12 months or the end of the following year. All right. So in other words, if we say in November we had a 1-year insurance premium that we were going to pay, we can go ahead and pay that, since that insurance premium doesn't go beyond 12 months and it doesn't go beyond the end, but beyond the end of the next year. We can go ahead and pay that in November. We can take that full deduction on this year's return. All right. One thing worth noting here is bank interest. You can pay up all of your accrued interest at the bank. If you got a loan at the bank and you have accrued interest at the bank, you can walk into the bank and you can pay your accrued interest, and that's 100% deductible. You can't prepay your interest. All right, so that's critical piece to talk about there. Now, on prepaid expenses, the the main rule is that we can prepay up to 50% of the Schedule F expenses. So if we look at when we get done with the return, we look at the total expenses on the Schedule F, including depreciation. Chop that number in half. That's the amount that we can prepay. All right, so it's a tremendously, it's a tremendous tool that's out there. Now, the that 50% limit is in force. You can go over that limit, but in order for that to happen, you couldn't have gone over the limit in the three preceding years, and you have to be a farm-related taxpayer. Now, farm-related taxpayer, you got to live on the farm, principal business is farming, or you have to have a family member that meets that the farming piece. Now, so in other words, if you haven't gone over in 3 years, you can go over that, as long as you haven't gone over that thing in 3 years and you're actually doing the farming. Now, on the prepaid side of things, folks, this is probably the most important slide I'm going to show you on prepays. All right, it has to meet particularly 1 and 2. All right. You actually have to be buying something. It needs to be a payment, not a deposit. I've had clients that walked in the door in February. We're getting ready to do the return. They hand me the paper from the co-op, and it says right on the co-op paper that it was money on account. In fact, the co-op was paying them interest for the money on account. They hadn't bought anything. All right, no prepaid expense to take in that regard. All right, yeah, you need it if you're buying seed or fertilizer or chemicals or supplies. You need to actually be buying those items. All right. Now, the business reason for doing that is simple. You're assuring yourself of a quantity, and oftentimes you're getting a discount. If you buy, if you buy stuff in the fall, oftentimes your seed, chemicals, fertilizer, that's going to, oftentimes you're going to get a discount by buying it in the fall, and that's something that you're going to be able to do. All right, the no material distortion of income. I don't worry about that so much, because once farmers start to prepay, they typically do it every year. So as long as you've got a habit of doing that every year, I don't worry about the material distortion of income because we're not changing anything massively from one year to the next. Now, uh, let's move on to another topic here. Schedule J, income averaging. Now, income averaging is something that you can do right up until the time that you file the return. Right? You do this thing on the return. We don't have to do if you're wanting to do income averaging, you don't have to do anything with that before the end of the year. All right, this is something that your tax professional is going to be able to work, and if this benefits you at all. Now, on the income averaging side of things, it only works for farm income. All right, you can't income average a hardware store or any other non-farm business. It only works for farm income, and it doesn't change your self-employment tax or your taxable income. What it does is it just blends those rates and allows you to work with some blended rates. Let's look at the chart here. This is something that I kind of drew up in Excel and have been using the thing for several years. Now, uh, what we're representing here. Get my laser pointer going here. This line here represents the top of the 12% bracket. All right. So everything up here is 22% money. Everything down here is 12% money. All right. Now, for this producer, they had income levels in 21, 22, and 23 that were all below the top of the 12% bracket. Now, in 24, they had all kinds of income. All right, had a really, really good year. Perhaps they got one of those DFAT payments, possibly, which is also farm income that would also increase that. Now, what they can do with this on income averaging, as long as it's farm income, what we can do is we can take money from this 22% bracket and we have to equally put it back into these prior 3 years to fill up some of those unused 12% brackets. All right. So what we're doing is we're effectively taking 22% money and putting it back into the unused 12% money in those prior years. Now a couple things that we have to do with income averaging. We have to put the same amount of money back into all three of the prior years. So if I decide that I want to take $30,000 from 2024 and put it back into the prior years, I am forced to do 10,000 in 23, 10,000 in 22, 10,000 in 21. All right. I pick a total dollar amount. It divides them equally amongst those prior 3 years. I can't just pigeonhole a whole bunch of money into 1 year and leave the other two alone. It has to be equally allocated. But the question always comes up, how does this benefit you? Now, it doesn't change self-employment tax. All right, it does not affect self-employment tax. All it does is it changes the rate of the regular income tax rates. All right, and it can be significant. All right, so it's something, and folks, you don't have to amend old returns. It's filling out one form. All right, so talk to your tax professional about getting that done. All right, because it's to your advantage to fill that out, and a Schedule J is where that gets filed. Okay, let's talk a little bit because I know we got a lot of livestock producers that we need to talk about here. Now, as far as deferring crop and livestock sales, and as far as the livestock and the crop, these are pretty much interchangeable. I'm sorry if I led you to believe otherwise a moment ago. The when we're deferring sales, oftentimes producers might have a contract in place where you have to deliver a certain amount of quantity of commodity under for a certain date. For instance, I'm coming to you from I'm coming to you today from Marshall, Minnesota, which is where I live. We happen to have an ethanol plant in town. A lot of the local producers will deliver corn to the ethanol plant. All right, and a lot of them will contract ahead of time, so they may have a contracted December delivery. All right, now what the producer may do if they've got that contracted December delivery, they go ahead and make the delivery, but what they do is they enter into a deferred payment contract with the elevator, with the ethanol plant, if they don't want to receive the money until the next year. Folks, you can't just hold the check. All right. If you go to the ethanol plant and they cut you a check, you can't just not deposit the check till after the first of the year. Those are under the constructive receipt rules. You can't do that. I mean, if they hand you the check, you got to count it as income in 2024. Now, if you do a deferred payment contract, you enter into a written agreement with the ethanol plant, or it could be a co-op, or it could be a grain buyer. And what they do is that deferred payment contract allows you to defer that into the following year. And that contract has to say you're not going to get paid until, into 2025. All right. So the thing about deferred sales, okay, it's allowed under the installment sale rules. This is something that's been done for years. Just some folks aren't really familiar with it. The producer, you got to have that binding contract. All right, you has to be a signed contract, and you can't get the money early. All right. Now the detrimental part of these deferred payment contracts is that you are an unsecured creditor if you do one of these things. So the risk involved with this is if the elevator or the ethanol plant or somebody happens to go bankrupt in the meantime before you get paid, you're pretty much last on the list out of the bankruptcy court that's going to get paid out of that mess. So that's the risk involved with that. But they are an effective tool for deferring income into the following year. Okay, couple of the things that we want to touch on here is weather-related provisions for livestock sales. Now, there's several different rules that we want to talk about here on this. We've got animals that may be sold due to weather-related conditions. Now, we had a lot of widespread drought this last year in 2024, so this very likely could be a condition that exists in your particular area. If the first one, I put these into two different categories as far as the breeding livestock. Okay, so if you had, say for instance, if you're a cow-calf producer and you had to sell cows, because you just didn't have any pasture, you didn't have any hay, you didn't have feed. And, if you sold those, you have to sell those animals due to weather related conditions. You're allowed to defer the declaring that income until a later time. All right. Essentially, it gets treated kind of like a like-kind exchange. You can defer that income, but under those circumstances with breeding livestock, you're required to buy them back within 2 years. All right. You sold those cows because of weather-related conditions. You're just required to buy them back inside of 2 years, and you don't have to declare that as income. All right. The no disaster declaration is required under those circumstances. Now, the other one that we want to hit is the raised animals. All right. Let's say that you're, again, cow-calf producer and you had your calf crop. If you sold more calves in 2024 than what you normally would have, and it was because of weather-related conditions, you can defer those sales into the following year. All right, and you're perfectly allowed to do that. The difference is with the raised animals, you with the raised and this also can apply to the breeding stock as well. You have to have a disaster declaration for your county or an adjacent county. Let me say that again. In order to do this type of a deferral for either raised animals or breeding livestock, you have to have a disaster deferral in your county or an adjacent county. All right. But this does work for either the raised or the breeding livestock. But what the difference between this is there's no buyback on this. You can just elect to postpone it until next year. So it's a 1-year deferral. Okay, let's talk a little bit about depreciating assets. Excuse me a second here. You probably detected me getting a little dry. So, okay, one of the first things, in fact, I was in a meeting last week where we got into a discussion on this. When it comes time to depreciate something, we need to, first thing we're concerned with is when it's placed in service. Now, we can't start depreciating something until it's placed in service. Now, here's the simplest example that I can give you. If some farmers with the fast depreciation write-off with 179 in bonus, a lot of folks in previous years have decided to, they'll go buy machinery and they'll write off the entire piece of machinery. And it's something that's fairly commonplace in today's day and times. The key point that we need to make clear is that in order to do that, you need to have possession of the piece of equipment. Right? If you go to the implement dealer on December 31st and you fill out the paperwork to buy a new tractor, right, but you don't bring the tractor home, that is not placed in service. All right, just doing the paperwork at the implement dealer does not consummate the deal. All right, you have to have the tractor on the home place ready for action. That's what placed in service means. All right, so that's a key critical thing. Now, excuse me. The recovery period for different types of machinery. Okay, new machinery is going to be 5-year property. In other words, it gets spread over a 5-year period of time. Used machinery gets spread over 7 years, and the uh, the other assets that are commonly done, grain bins, fences, they're still 7-year property. We've got a chart coming up here shortly that's going to be much more comprehensive on that. Okay, we brought up the topic of Section 179. Now, Section 179 is something that's been around for over 30 years. It's what it is. It's a fast write-off that we can do on our capital assets. Now, it works on assets that are anywhere from 3 to 15-year property. Now, I'm going to have a chart up here next that's going to illustrate that. 3-year property is swine breeding stock. 5 is anything, cattle and dairy livestock. 5-year property is also new machinery. 5-year property is new machinery. 7-year property is used machinery. 10-year property is single purpose ag structures, and 15-year property is drainage tile. 20-year property are your barns and machine sheds. So essentially it's anything from that 3 to 15-year property. But folks, you can write off over $1.2 million worth of purchases in 1 year. All right. So you can generate a tremendous amount of expense. The limit, the purchase limit is over $3 million. So you'd have to buy over $3 million worth of stuff in order to not be eligible for 179. So it is a very, very tremendously valuable tool in that regard. This is a chart that I plucked out of publication 225, the Farmer's Tax Guide. And it lists your various categories of asset. The GDS category, that's general depreciation system, this is the column that you want to pay attention to. All right. So in other words, we're looking at machinery new is 5, machinery used is 7. All right. Cattle is 5. Buildings are 10. That's drainage tile is 15. All right, so you get the idea. This is the chart that allows you to find out what class life that those assets are. All right, but again, 179 can be used on anything that and this chart also shows you yes or no on 179. And the only thing on this list that we can't are the farm buildings because they're 20-year property, and 179 only works for 3 through 15. All right, so buildings are really the only thing that's off the list for 179. Now, one additional
Rob,
yes.
there is a question in the chat box that I do feel like is right here in this same area. And it says, is there any tax advantage or disadvantage to having a cow-calf operation versus raising stockers. So example, buying 400-pound calves in the spring and selling them in the fall.
Uh, Randall, I think your question is probably going to take an hour long to explain. I think you need to look at there's a number of business things that need to be addressed there. A lot of it just depends on your access to feed and your your ability to buy calves versus doing the cow calf. And, what I'd encourage you to do is if you've got access to someone that maybe has possibly an adult farm management program or something. I mean that's if that question were raised here in Minnesota, we'd probably refer you to the adult farm management program, and I think that question, to answer it properly, you need to sit down and kind of push some numbers on that and see which one's going to work the best, because the answer is it depends. All right, and I can't answer that right now, but you need to look at probably some long-term cash flows and see what's going to work best for your operation, and that's going to depend on availability of feed, your current farming status, access to resources, and the like. All right. Hate to waffle on that one, but good question. But I'm afraid that's going to involve probably some long-term planning and consultation. All right. On back on the business on the bonus depreciation here. We've already talked about 179. Now let's kind of hit the bonus depreciation in this regard. The bonus depreciation is also a fast write-off of your capital assets. Now, you remember the last chart that we looked at on class life. Class life for bonus works 3 through 20. All right. So I'm going to back up just a moment here. All right. So when we looked at 179, the only thing on here that was a no for 179 was farm buildings. All right. If we were to make another column on here for bonus, the farm buildings are allowable under bonus. All right. And that's primarily the main difference. Now, for 2024, bonus depreciation is set at 60%. So if you spent $10,000 on an asset and you decide to take bonus on it, you're going to get a 60% write-off of that $10,000. So you'd be depreciating the 40,000 that was left over. All right. The bonus is like a light switch. You elect it and shut it off by class life. All right. So in other words, the tax return always assumes that you're going to take bonus on everything, and you have to shut off what you don't want to take it for. All right. It's not nearly as flexible as 179. 179, I can pick and choose which individual asset that I want to write off, and I can selectively elect how much money I want to write off on each of those assets. 179 is much, much, much more flexible. Okay, next piece here, and I got okay. I see the Q&A here. Let's go here. Okay, when using 100%, when using a 179, you can deduct 100% of the cost of asset. Correct? If under the purchase threshold. Yes, that is correct. When purchasing equipment using standard depreciation, do I still get to deduct 100% of the cost as in the purchase price divided? Okay, I see where the question is going from. If I were to buy a tractor, folks, and I know the big number, but let's just say $100,000 tractor. All right, and I decided to take 179 on that, write the whole thing off. All right, I'm going to get a $100,000 deduction for 179 when I take that 179 deduction. Moving forward, I'm going to get zero depreciation because it's the remaining basis in that asset that's going to depreciate moving forward. All right. So once I write it all off using 179 or bonus, I'm not going to get depreciation in the future. All right. Excellent question, and good thing to clarify here. Okay. Going to shift gears just a little bit here and talk about crop insurance, because this will be a topic of discussion. Well, it is a topic of discussion right now. I've already mentioned that across Oh, across multiple areas of the country, we had horrible drought this last summer. So we've had and on top of that, we had terrible flooding in the spring, and then it dried up, dried everything up in the summer. So we took it both ways this last year. Crop insurance, I think, is one of the most beneficial risk management tools that you can possibly engage in. I've always been a proponent of crop insurance. I also encourage people to sign up for the farm programs, like, if you're eligible, if you've got eligible commodities for Arc County or PLC, or certainly enroll in those programs. It doesn't cost you anything. But crop insurance, this is something, if you've got eligible crops for crop insurance, and if you don't have eligible crops, you've got the NAP coverage that's out there as well. So I always encourage everybody, look at that crop insurance option. Now, one of the things that we can do with the crop insurance piece is, we do have a narrow window where we can defer that crop insurance into the following year if everything lines up correctly. Now, the main point that we need to start with here is, if you're looking at deferring crop insurance, many of the crop insurance vehicles out there right now have two components to them. There's a component that's for uh, paying, making payments due to damage and destruction, and there's also some products out there that will guarantee revenue. All right, and it's based on a harvest price and a contract price at the time that they purchase the insurance. Now, you can only defer the damage and destruction portion. All right, pay crop insurance payments that are revenue based are not deferrable. You have to take those in the year that they're received, and there's no wiggle room on that one. That rule is pretty hard and fast. Now, in order to be able to defer, all right, you got to be on cash basis. Now, folks, 99% of farmers are on cash basis. The other alternative is accrual, and most farmers are cash basis. You need to establish, under normal circumstances, that you would sell that crop in the following year. All right. Now, there's a revenue ruling and a Nelson commissioner, and I'm going to clarify this a little bit. I should have added a slide for this, since this is a national webinar. The Nelson case, along with revenue ruling 74-145, what that's showing, that's telling us is that we have a special set of rules for folks that live in the Eighth Circuit Court of Appeals. This is where I should have added the additional slide, and I apologize. Eighth Circuit Court of Appeals is the Dakotas, Nebraska, Minnesota, Iowa, Missouri, and Arkansas. All right, let me do that one more time. It's the Dakotas, Nebraska, Minnesota, Iowa, Missouri, and Arkansas. All right, that's the Eighth Circuit Court of Appeals. That's where this rule applies. If you live in the Eighth Circuit Court of Appeals, you have to look at each and every crop that you produce, and you need to be able to show that you normally would sell over half of that crop the following year. So, in other words, if I live in the Eighth Circuit Court of Appeals, if I'm growing corn and beans on my farm, and I can show that I normally sell over half my corn the following year, and I normally sell my soybeans the following year. All right. If I'm cash basis, then I'm allowed to do that deferral if I so choose. All right. In the Eighth Circuit Court of Appeals, if I sold over half my corn the following year, but I didn't sell over half my beans, it poisons the well, and I can't defer any of it. All right. It's a narrow decision. It's only for the Eighth Circuit Court of Appeals. Outside of the Eighth Circuit Court of Appeals, all we have to show is, if you sell over half of all crops the following year, then you're eligible for deferral. All right. I think the outside Eighth Circuit is probably is without a doubt. I think it's the correct interpretation, but that's what's being enforced right now. So we have a narrow set of rules in the Eighth Circuit Court of Appeals. All right, let's look at tax planning here a little bit. All right, I've got some stuff here, and I want to kind of walk you through some things that I do with folks when we're doing some tax planning with clients and farmers. Here's this comes from the IRS website. These are, in fact, these are your different filing statuses, and we've got tax rates ranging anywhere from 10 to 37%. So most cases we do examples for married filing joint. And as I mentioned, we've got a 10, a 12, a 22, 24, 32. We get up to 37%. We got a lot of money on the return in order to get into that 37% category. So, but that's where these breaks are occurring on the chart. Now, we've already looked at the chart, and I've already explained that. But what we're going to do is we're going to look at a tax planning example, and we're going to show you, some techniques that you can do to try and mitigate some tax bills. Now, on your 1040, we all have a we're allowed a standard deduction based on our filing status. So I happen to be married, so on my return I'm going to have a married filing joint deduction of 29,200. In other words, I can basically deduct $29,200 worth of income, and that happens on the 1040. That's money I don't have to pay tax on. All right. So that's a deduction that I get right off the bat when we're looking at that. Now, this example that I've got here, the numbers are a little bit on the big side, but I weighed the options of knocking this thing down. But I've had so many calls, folks, from folks that have received some of those USDA discrimination payments, the DFAP payments, and some of those were sizable. So I thought, all right, we better do an example with some big numbers and show everybody what kind of impacts it is. So not trying to offend anybody by going with big numbers on this thing, but that's I weighed the option of doing it both ways, and this is the way that I landed on. So what I've got here is we've got a situation that all right, I'm tax planning this farmer. They walk in the door. Now we're planning on doing some tax planning. They walk in the door and they've got $200,000 showing on their Schedule F for net profit. All right. There could be, a number of things on here, but there's a lot of money on the Schedule F. All right. By the time we get done taking the qualified business income deductions and the standard deductions and all that sort of stuff, we end up with taxable income in this case of 126,000. All right, because I ran this through my tax software. Okay, federal tax bill was just about 18,000, and there's about $26,000 worth of self-employment tax. For this individual, I mean, the total tax bill federally is going to be a little over $44,000. All right, if we were to do nothing with it. But this individual is still in that 22% bracket. All right, now remember, 126,000 of taxable income. Folks, that's about right here in the dead set in the middle of the big green hump. All right, and you see here, essentially we're sitting at about a 38% marginal tax rate. We're not figuring anything for a state income tax. If you lived in Minnesota, you'd have a state income tax bill on top of that. So this is a horrendous tax bill, and we're right in the middle of a tax rate where we really don't want to be. So here's what we're going to do about it. All right. So I'm just kind of playing with this a little bit. What we're going to do in this case is we're going to prepay $20,000 worth of crop expenses for next year. All right, might be fertilizer, chemical, seed. We're prepaying crop expenses to the tune of 20 grand. All right. We also happen to buy a piece of machinery over the course of the year. We're gonna do a fast write-off of 22,000 for this fast machinery. Now, please note, I'm not taking really big chunks here. I want you to I want to show you what the movement from point A to point B is going to do. So what we're doing in this example is I'm adding $42,000 worth of farm expense to the Schedule F. All right, so we started at 200. I've got the Schedule F down to 158 by doing what I'm doing. Now let's run the numbers. Okay, we were at 126,000 for taxable income. This takes it down to 94. Okay, federal is going to be just about 11,000, a little over 22,000. Total tax bills 33,155. Still a big amount, but we're in the 12% bracket now. All right, so folks, what we did is doing $42,000 worth of prepayments, adding $42,000 worth of expense. It took us from here down to here. All right, and what I did is I got rid of all this expensive money up here that's getting taxed at a much higher rate. All right, I mentioned this earlier, and I'll mention it again. I pay more attention to the rates than I do the dollars. All right, and that now producers may vary on that, but you know what? But I think that, you know, over time, the just paying attention to rates does make sense. Now let's look at what the impact of this is. Okay, we spent 42,000 in the way of prepayments and accelerated depreciation. All right, we cut the tax bill by just about $11,000, so we're saving about 26 cents for every dollar that we did a prepayment for. Now, some folks are going to ask, well, why weren't we saving 30 cents on the dollar for everything that we spent? Answer for that is simple: QBI. All right, we've got that qualified business income deduction that's looming out there that really isn't part of the tax rates. And the problem is once we lower that net, we're also reducing the amount of a deduction that we get with the QBI. So the QBI actually makes tax planning a little bit harder, even though we have that extra deduction out there. All right. So the bottom line is, we're, you know, by prepaying that thing, you know, in this example, we spent 42,000. We're saving about $11,000. All right. That's pretty good rate of return on that money. I see the. Okay, now I guess the question got taken care of. So again, now if we're sitting here, right, and you're the producer, and you're going, all right, well, I'm still not real crazy about a $30,000 tax bill. You know, you can do additional prepayments and get yourself down to maybe here, significantly lower the tax bill. But remember, you know, since we're in a lower rate, we've got to spend more money from here to here to get that same amount of tax savings. All right, and that's the main thing that I want you to understand is, the lower you go on the chart, the more money you have to spend to lower the tax bill. All right, but as long as you're not going over that 50% threshold on the prepayments, you're okay on that. So, you know, significant tax bills. You know, unfortunately, the thing that's been in vogue the last few years has been to go buy a piece of machinery and write the thing off. All right, and that's the 179 in bonus. I definitely favor the 179 over bonus because I think it gives you much more flexibility. All right, definitely gives you much more flexibility. Okay, questions. I guess Harley, is there anything, I guess, hanging out in the chat that we need to address?
At this point, no, I don't believe so. I think we've answered everybody's questions.
Okay.
Feel free to continue to put them questions in the chat or in that Q&A question box, and we will get those questions answered for you.
Okay. All right. And I still, and Harley and I talked, I still have the Schedule F piece to go through. And I think that's going to be a worthwhile, piece as well, because that kind of helps tie the records back into vogue. So as far as this goes, what I wanted to talk about now was just kind of walk you through the Schedule F, because that I think serves as a really good reminder for the for the folks that if you're putting together the records really should emulate the Schedule F. All right, because the Schedule F, of course, if we have another business entity out there, some entities are going to be still filing a Schedule F, but once we get to corporations and everything, there's a worksheet, and Schedule F kind of goes away. But this is the top portion of the Schedule F, and we'll kind of talk you through all of this, moving through this piece here. But essentially, what we do is the Schedule F. It's the form that's used to collect your farm income and expense. Now, it gets attached to the 1040. It's typically going to be filed by someone who is a sole proprietor. Many software packages, even in a farm partnership, are still going to utilize a Schedule F as part of their software. It's much easier to report all the farm income and expense in the software. Now, most one of the first things that we have to decide, and it's probably already been decided for all of your operations, you're either going to be two different methods of accounting, either cash or accrual. All right. Now, folks, in the time that I've been doing farm tax analysis, and since 1990, I've only had two people ever worked with that were accrual. What accrual method does is accrual method takes into account beginning and ending inventories, and that is critical towards the calculation of farm profitability on Schedule F. All right. Now, my opinion, it is accrual is a much more accurate calculation of farm profitability. A cash basis Schedule F doesn't really tell us anything about the farm's profitability unless we do a farm business analysis. All right, because we're doing all these things at the end of the year in the way of prepayments, writing off stuff fast. I mean, we're doing everything to manipulate the tax bill. It's not a good profit measure in that regard. But cash method is by far the most common practice, and all we're doing is when a cash transaction occurs, either income or expense, that's when we book it. All right, that's when we report it on the records. That's when we have constructive receipt of income. Accrual method, what we do is that's when inventory is accrued. Now, the one thing that does differ with this is, if you book for the sale of some cattle, for instance, and your accrual, that's when you mark it down as income, is when you actually book the sale. All right. So there are some subtle differences on the income reporting side of things, but for the most part, it has to do with the page 2 calculations, where we take into account the beginning and the ending inventories. At the top of the Schedule F, there's a code that goes at the top. And in other words, if we got a cow calf producer out there, they'd be code 112, 111. All right. And what we do is we put that code. That code ends up going in that code from that code ends up going right here. And what that does is the IRS picks that up, and because they're looking for certain patterns of income and expense for certain types of farming operations. All right, so it just helps them to match everything up. As far as the top of the Schedule F, the lines 1A and 1B. Now, the question early was raised about a feedlot situation. Now, if you're doing purchase for resale livestock, now purchase for resale livestock is a little different animal, because if you're buying calves and putting them in the fat lot and finishing them out to market weight, uh, we can't deduct the cost of those calves until we actually sell them. All right. So we carry that cost through the period of time that we're feeding those animals out. We report the sale of the market animals on line 1A, but we report the cost at the time that we sell them on 1B. So the actual profit for the cattle, sale price minus the purchase cost, gets calculated on 1A and 1B, and the net is on 1C. All other livestock that's sold, raised animals, are all going to, and crops raised, crop commodities, livestock commodities raised, are all going to be showing on line 2. Co-op distributions, that's a number that comes from the 1099 PATR. If you're doing business with a co-op, you're going to get some type of a 1099 from the co-op. There's going to be patronage, possibly some other, other items on that 1099 that are all reportable, that have to be reported on line 3A and 3B. All right, and that comes from the 1099. If you participate in any ag government program payments or any government programs, the if you're participate with any FSA programs, if there was any payments that came from that, you're going to get a 1099G, and that's where those numbers get reported on line 4A, 4B. CCC loans. All right. We've been talking about this a little bit this year, especially from the younger producers that might be trying to get a little more income this year. A CCC loan is if you've got commodity on your farm, and it happens to be a qualifying farm program commodity, you can actually pledge that stored grain and get a low interest loan. And you've got the option of treating that low interest loan as income on the tax return. That's what's happening with line 5B. If you get crop insurance, you do have to reflect that crop insurance on line 6. You will get a 1099 on that. And I should mention 1099s, if you get a 1099, the 1099 is going to get reported to Internal Revenue. All right. So you want to make really good and sure that you load up all those 1099s and you take them to the tax office when you sit down to do your tax return with the tax professional, because one of the jobs of the tax professional is to make sure that they get the numbers from those 1099s on the tax return, so the IRS computer is going to be able to find them. All right. That's one of the key things that they do. Custom work. Say for instance, if you did some, say like if you did some tillage work for the neighbor, or maybe did some dirt work or machine hire, or something along those lines. That's what that's going to get reported. Other income could be coming from a 1099. It might be a fuel tax refund. What we do is we just add everything up on line 9, and that's our gross farm income. So the bottom portion of the Schedule F is going to be a listing of all your expenses. I'm not going to spend too much time on this, but in your records, any car and truck expense that you have, chemicals, conservation expense, custom hire, depreciation, all your depreciation is going to be summed up. That gets calculated on the 4835, and that bottom line number comes back to line 14. If you take any 179 or bonus, that is also going to be reflected on line 14. If you've got employees, benefits are going to be on line 15. And line 16 is going to be feed. Okay, we got a lot of livestock folks on here I'm suspicious of. If you have fertilizer purchased, freight and trucking expense, fuel, insurance. Now your health insurance doesn't go on line 20. That's a different spot. But interest paid goes on 21. Your hired labor goes on 22. If you've got employees and you happen to be doing a pension program, that would be line 23. If you're renting anything in the way of machinery or land, all right, that's going to be reflected on line 24. The line 25 is going to be your repairs and maintenance. All right, we talked a little bit about those repair regulations. All right, but that's where the sum total of the repairs are going to be. Seed is going to go on line 26. If you have any storage or warehousing costs, that's going to be reflected there. Add it all up, and the total expenses get down here on line 33, and the net gets calculated on line 34. Just a quick trot through on this. I mentioned a couple times on the tangible property regulations. This is kind of going back to that repair reg. The safe harbor For most operators is going to be $2,500. Now that's for folks that don't have an applicable financial statement. If someone has an applicable financial statement, most cases that's going to be an audited financial statement with a CPA. That's a pretty specialized deal. You can jump that invoice per invoice cost to $5,000. Most everybody's going to be at this $2,500 level. All right. The other items that are listed here on Schedule F: supplies, property taxes, utilities. Make sure, folks, that we're only including farm utilities, not, house utilities shouldn't be showing up in there. If we've got vet or breeding fees and other expense, typical things that are going to be shown as other expense, I typically will list if I have marketing expense that's on there, professional services that would include the cost of the accountant, and or if I have a crop consultant that I'm paying on that regard, that I'm going to list as other expense. Okay, we total it up on line 33, and then it nets out on line 34. All right, so that's the bottom part of the Schedule F. The back page of the Schedule F is only filled out if you're accrual basis. And what you're going to notice is that a lot of the income numbers are the same as the top of page 1, except for it's asking you for beginning and ending inventories. All right, on the back page. All right. So the back page is accrual, and it does those accrual adjustments. Essentially, it takes everything from page 1 and applies those accrual adjustments. Okay, I see a couple more questions here. Let's do those. Okay, question is it beneficial to shift to a nonprofit farm if you're a small specialty farm primarily supplying food banks and training beginning farmers? Possibly. What you want to do, Holly, in that case is I think you need to get a hold of you need to get a hold of somebody that really specializes in nonprofits. Nonprofits are really an animal all of themselves. They don't necessarily follow the others. I'm familiar with several nonprofit operations. You need to get a hold of somebody that is familiar with how that type of an operation is going to be operating. And typically you're going to be, if you do that, you're going to probably be operating as a 501c5, okay, which agricultural operations will qualify for doing that. Now, the other thing here is, okay, where do my canned goods get listed in my Schedule F? Well, Holly, here's the thing, and good question. I'll try and shorten this up as much as possible. Your canned goods, unfortunately, are not going to be a Schedule F item. All right, Schedule F in the case of a farm, that's going to be unprocessed produce. Case in point, let me use an example of an apple orchard. All right, apple orchard sells bulk apples. All right, that's Schedule F. We harvested the apples. We're selling apples. But when you move to the gift shop and they make the apples into pies, jams, jellies, all that stuff. Once we process that stuff, that becomes non-farm business. All right, so what you've got there is you got processed stuff, so you're going to have a split. Some of the stuff is going to be a Schedule C, which is non-farm business, and some of that, the production of the commodity is going to be Schedule F. Again, find yourself a competent accountant, and sometimes if you get some size to that thing, that's one of those operations that if you get some size to it, you may want to split it into 2 different entities to just keep everything kind of straight. Okay. Okay, what if livestock risk protection money? Yeah, that's essentially, any livestock risk protection money that's going to be either reported, on a 1099, and that is going to be taxable. Yes, that is going to be taxable. Typically, that's going to be, it depends on whether it gets reported on a regular 1099 or whether it gets reported on a 1099 government form. If it comes on a government form, a 1099-G, it needs to go on the government income line. If it comes on a 1099 miscellaneous, it's typically going to go on the under other income. So it depends largely on what type of a 1099 it comes from, but it's going to be taxable, and then it's a supplemental income piece. Okay, let's see here. Question: how much carryover from a farm loss, and how long can I keep moving into the next year? Well, Holly, there's a farm loss limit out there. It's for most folks, it's going to be in that $300,000 range, and I'd have to look it up to find that. If expenses exceed income, it's typically what you're going to end up with is a net operating loss. Now, with a net operating loss, you've got the option of possibly carrying it back on a farm. You've got the option of carrying it back 2 years to absorb. If in the prior 2 years you had income that was reported on a tax return, you can take that back 2 years. You can get some money back if you paid tax the last 2 years, or you can elect to waive the carryback and carry it forward and burn it up with future profits. And you're not limited in the number of years that you can carry that forward. The amount of carry forward time on that is indefinite.
There's
Oh,
also one question in the chat box. It says, I have leased a hay barn from Farm Credit. I have a 7-year lease with the bank with a balloon payment for the last payment. So are the monthly payments considered a lease payment or a conditional sales contract?
without looking at the contract, it's hard for me to make a determination on that. We've been seeing a number of these in the last year. Corey, the thing that I always have to look at with this is with the lease, especially with a building lease. If you are obviously gaining equity by making those lease payments, and it certainly looks to me like you are, because the way a true lease should work is you would, they would typically set this up as a 7-year lease or a 5-year lease, and what you do is you make a lease payment that is actually an economic. You're not gaining any equity in that building, and what you do is you buy it out at the end for an estimated fair market value. All right, if that's the way the lease is structured, you can treat those as lease payments. All right, if it doesn't meet the qualifications of a lease, it's a conditional sales contract, and you probably need to sit down with your accountant and have them review it. We've taught that really a lot in the last couple of years in our ag tax courses, and but those are becoming more and more common, and I think you need to be cautionary on that, because the thing I look at on that is if you're gaining equity by all of the lease payments that you're making, it's not a lease. It's a capital lease, and it should be treated as a sale, or treated as a purchase and depreciated. Okay. Anything else?
I didn't see
I
anything else.
guess I did have a question slide here that I should have flipped up here a couple minutes ago. Believe I have. Okay, a couple things here that just before we wrap up here, folks. This just a reminder. This was funded through a USDA Extension Risk Management grant. And folks, here's my contact information. I'll leave this up here a little bit as well. I certainly welcome questions. Now, folks, I will appeal to you about this. This is my busiest time of the year. So what I would encourage you, if you do have questions, please shoot me an email, because I travel a lot. That phone number does ring at my desk, but I'm probably gone this time of the year a lot more than I'm here. Email's probably by far the best way to reach me. All right. With that, Harley, anything else out there?
No, I don't think so. I do want to remind you guys that I will be sending out a link to the recording of this webinar. And I want to thank everyone for joining us today. It was such a wonderful presentation, and thank you, Rob, for doing this. We will have another presentation on Thursday at 2 p.m. Central Time. That will be over business entities. Just like Rob had said a little bit earlier, it's more about business structures, LLCs, S corps. And if you guys have any questions, feel free to send them to me and I can get them to Rob and get back to you. Just be watching for that email from me. It'll be at harley.moore@nativeagfinance.org. And that will have a registration link for Thursday's webinar also.
All right. Well, very good. Well,
And I'll just leave this up for a couple more minutes. So if anybody else has any last minute questions, feel free to shoot them to us. But if not, I'll go ahead and end the recording and the presentation. Back about 15 minutes of your day.
okay. Harley, you were cutting out a little bit there, really bad. I guess, did we